Thank you for tuning in to Investment Insight presented by McCay Wealth Advisory. My name is Hayden Proffitt. Joining us today, we have Brent McCay. Brent, some estate planning guidance.
Right. So one of the big changes in the new tax bill is now couples can leave up to $15 million each tax-free to the next generation. Now, in 2010, spouses got what's called portability, which meant that you didn't have to separate your money, that you were allowed to claim your spouse's $15 million in credits this year when they died. But there was a recent IRS case where a couple, the gentleman I believe had died, or she had died 3 years earlier, but they had not filed an estate tax return because they didn't need one, because you can pass money to your spouse tax-free. Well, the IRS and the tax court just ruled that he did not get her portability of her credit because they didn't file a return. So even though a return wasn't necessary, in their case, it really was. And so one of the things that we want to encourage people to consider is, if you were to lose a spouse or a family member, you need to go ahead and claim that credit with the IRS, because the IRS ruled because their tax return wasn't finalized and done, he didn't get it. And the tax courts agreed with the IRS. So right now, a married couple can leave $30 million to their heirs tax-free. However, if you're close to that $15 million level at all, you probably want to go ahead and claim your spouse's credit when he or she dies. Now, we believe the requirement is 9 months to file it, but you have up to 5 years to extend that. So it's probably a good idea to get on it and file for those credits, just to make sure you have them. Because who knows, right now they've raised it to $30 million, later on they might lower it to less money. So, but if you died that year, you should have that credit going forward. And so they have raised that number again to $15 million individually, $30 million a couple, and you get portability, but you need to make sure that you fill out the paperwork.
Right. And
get a good attorney or accountant to do that paperwork for you.
Right. Well, let's also hit on this. If your spouse dies as well, it's a great time, well, it is an ideal opportune time to update beneficiaries as well.
Correct. So
on an account.
Obviously, one of the biggest things with beneficiary designations is if you designate a beneficiary on an account with us, it supersedes your will.
Yeah.
So it's very, very important when you look at per stirpes. If you wanted to go a certain way, or you wanted to do go to X, Y, or Z, if you want to follow that family line, you need to make sure you mark per stirpes.
Yeah.
And so anytime you look at your accounts in general, you need to make sure your beneficiaries are correct. There was a recent court case we talked about in the past where a gentleman had named his ex-girlfriend from 40 years ago as his beneficiary in his 401k. And she ended up getting his money. Supreme Court ruled, even though he had family and kids with it, in his new marriage, that original designation superseded his will.
Yeah.
So make sure you always are checking your designations.
Sure, absolutely. Well, thanks for talking to us about this today, and thank you for tuning in as well. Hope you have a great day.